Welcome on board now, Mr. JS Gujral, the MD at Syrma SGS Technologies, and talk about how their quarterly performance has been. Mr. Gujral, good to have you on ET now. You've delivered a 45% top-line growth and guided for around 75% in Q4. Tell me how much of this momentum is order booked backed versus project-based lumpiness?
No, see, when we give the guidance for any year or a quarter, it's always backed by the order book in hand. And it's sort of the order book which is going into production. So we're very confident of delivering what we have committed for this year to the street.
Mr. Gujral, therefore, 30-35% growth. How likely with regard to you going forward into FY27? And you've guided for a very strong growth in Q4. Talk to us about how that will likely play out.
See, we have already done about 3,350 odd crores in 9 months. And we are guiding anything between 4,800 to 5,000 crores or 5,000 crores plus minus 100 odd crores. As a total, which means I have to do approximately 1,500-1,600 crores. And last quarter we did 1,200 plus. And fourth quarter is typically normally the biggest quarter in a year if we go historically. So we are on track to deliver what we have committed. And more than the revenues, I think what we are more confident is the quality of revenues which are coming in, which will enable us to surpass our guidance of the EBITDA, which we had in last quarter said it should be Q2, we had said it should be about 430, 440. We should be able to cross or touch the 500 crore mark, up from 324 crore of last year, which is a healthy, very healthy sort of bottom line growth.
Mr. Gujral, a large part of the kind of EBITDA margin gains that you've clocked this quarter is because of exports. I'm trying to understand what the Q3 mix is and whether that is sustainable, or will exports actually come off versus Q3, of course, and what should the steady state guidance be with regard to exports? Will you continue to focus on exports in a calibrated fashion, increasing the export quantum in your overall revenue?
Yes, I have always been of the opinion, and when I say I, means the management and the board, we have always been of the opinion that for a sustained profit-led growth, exports have to form a crucial portion of your revenue. And we are happy that we are sitting at about 25-26% of revenues on a 9 months basis coming in from exports. We did about 840 crores worth of exports in 9 months versus about 860 crores for the full FY25. Based on what we have done in January, what we're doing in February, and what we are likely to doing in March, I'm very confident that our exports would cross the 1,000 crore mark and touch about 1,100 crore marks, plus minus 10 crores here or there. Going forward, our endeavor is that the exports should continue to grow at 20-25%. This year, they have grown by about 25%. Going forward, which is 26, 27, and thereafter, I think we are well positioned to grow the exports. Now that the trade deal and the tariff uncertainty hopefully is behind us and it will not sort of reoccur, we believe that going forward, 27, 28 onwards, our export trajectory should be even healthier with access to the US market. Currently, despite the tariff we have grown, it's primarily on the back of European market and something to the other countries. But going forward, 2 years down the line, I think the access to the US market should enable us to grow the exports at least 20-25%. Our wish list is that exports should constitute about a third of our revenue, which are about 25-26%. So I have to grow exports by about 33% to reach that level.
So, Mr. Gujral, just an extension to that question. If exports were to reach a third of your revenue, do margins improve to maybe 11 or 12%? Because you're guiding for 10% currently. You've done above 12. Of course, it's a quarter where there has been a better export tilt. But does that therefore take your margins to 11 to 12% maybe if you do the 1/3 of your top line as exports? And what's the FY27 growth number like? 30% overall?
Yeah. The FY27, we should grow at the figure which you have indicated. Theoretically, if the exports form 1/3 of my revenue, then the margin should go up. But America, we are venturing out in a big way for the first time. And from whatever understanding and the feedback we have got from our teams, that the American market is slightly more price sensitive than the European market, but the volumes are very great. So theoretically, yes, if exports do constitute 1/3 of our revenue, there should be a margin accretion, but on a conservative basis, we are guiding 10%. I think, as I keep saying, we'll count the chickens when they are hatched as the quarters pass by.
Okay. And Mr. Gujral, if one were to therefore try and understand, US, at least the agreement with the US, at least at this point, the in-principle agreement, does it help you from a pricing perspective in a material fashion? And therefore, would US be a significant market going forward? Also, what's the prospect in the EU like? Because now we have an FTA. How is cost competitiveness shaping up for you in both those markets?
So I take the EU first. Now, we've been exporting to EU for almost 30 years. And we expect that the FTA would create a sort of an environment to grow this exports to EU bit more larger in the coming years. With the tariffs at 50%, it was a no-brainer. We were not competitive to export. But 18%, we are well placed with competing geographies. And I'm very confident that going forward, America would form a significant chunk of our export revenues. Just like you can't wish away China from the input side of the supply chain, for any country to have exports as a sizable portion of its revenues, country or company, you can't wish away North America. You can't wish away a 30 plus or $35 trillion economy for the exports. So that's why we believe that we are well placed and we are beefing up our presence in America to sort of encash on the opportunity which lies ahead of us.
Absolutely, get that point. Mr. Gujral, great to have you on the show today. Thank you for your time with ET Now.
Thank you. Thank you.